Good morning. My name is David Alvarez. I want to welcome everyone to our second in our series of governmental CPE sessions. This session today is called Fiduciary Activities and Leases, a tale of two standards, GASB 84 and 87. In our governmental world, these are two standards that have been a long time coming. We've been talking about them for years. Now we're just about really getting started in implementing and the planning process of being ready to implement should be in full swing at this point. So going forward, just want to do some quick housekeeping. Today's session is available for CPE. You'll be able to earn 2 credit hours of CPE. In order to qualify for those 2 CPE hours, you would need to log in on your own link. So if you're watching with a group of people, only the person who has that original sign-in link will be the one who will receive the CPE. You can always obtain another link and log in yourself to obtain that credit. Also, there will be polling questions today in order to be in compliance with the state boards of accountancy, and we have to keep track of attendance. And we do that through these polling questions. And I'll say it throughout the day today or throughout our session. It doesn't matter if you get the questions right or wrong. It just matters that you answer 80% of those questions. The CPE certificates will be distributed via email within 7 days. Usually it's much quicker than that, but if you haven't gotten one in 7 days, you can reach out in the email address down here at the bottom, marketing@cricpa.com is who you can send a message there if you've not received your certificate within 7 days. So quick bio of our presenters. We have 3 presenters today. Leading us off on the GASB 84 fiduciary activities will be AJ Bowers. AJ is a partner in our Albuquerque, New Mexico office. He's heavily involved in the governmental practice, and he's actually been leading our efforts on 84. He's spoken on the standard many times over three years plus at this point. So lucky to have AJ with us today. And our next presenter will be Becky Hammond. Becky Hammond is an assistant industry line leader in our government practice. And Becky's been leading our GASB 87, so our lease standard approach. Becky's in our New Orleans office. And then I'm the moderator for today's session. My name is David Alvarez. I'm a partner in Clearwater. So between New Mexico, Louisiana, and Florida, we've got the southern part of the country covered. And all time zones. So welcome everyone. I'm looking forward to a great session today. So our agenda, we're going to start off with GASB 84 fiduciary activities. And we're going to go through implement kind of the basics of the standard. We'll go through some implementation guide questions and answers. We'll have a case study, and then we'll show examples of what presentation is going to look like pre-84 and post-84. Then we'll finish with GASB 87. And again, we'll go through the implementation guide. We'll go through some implementation examples and then kind of show a software option that we've internally developed, kind of start the discussion there. So kicking off today, I want to turn it over to AJ, who will get us going on GASB 84.
Thank you, David. I appreciate that. I appreciate everyone getting up this morning and listening to some 84. As David said, we've been talking about this standard for forever. It feels like 3 to 4 years. And really, as we kind of get going with it this year, it's now here, unless we delayed again, which is what happened the last time. So the standard is now here. A lot of you guys are probably working towards the implementation of that standard. We're going to kind of walk through today, as David said, we're going to kind of talk about some of the meat and potatoes of what's truly within the standard and some of the technical jargon that's within it. I'm not going to bury a bunch of time in that. I've done this presentation multiple times, and I think this might be about the last and final time to be able to do it before everyone's working on it. So I'm excited that we're we're kind of working through that process. And we're going to go through that case study as David talked about, because that's really been through, that's where I learned a good portion of it is by doing. So really, when we look at fiduciary activities, what we're going to kind of go over is what the purpose of it was, is this information is actually not new. This information is truly under GASB 34 and a whole bunch of additional guidance. But as it relates to 34, there's been so much inconsistency in practice. So there's been inconsistency in the way that this has been implemented. It's been inconsistent as it relates specifically with what I'm going to call custodial funds. So GASB put together some information to clarify what that guidance is going to be and to really so that it's consistent within practice. Now, it was originally going to be effective for years beginning after December 15, 2018. So it would have been 2020, but with the issuance of GASB Statement 95 with the COVID delays, they delayed it a year, which I think was one of the bright spots of COVID. So is that it delayed everything, because I know from talking with multiple folks weren't ready. It was harder than people thought. There was not a lot of state guidance that came out. So there's been a lot of questions over 84. So I'm happy that we had the opportunity to work through it again. So the main things that it's done is it did two basic areas related to fiduciaries. One is it established this criteria in which you're going to identify what those fiduciary activities are and then the related reporting to those. And there's 4 paths that we're going to talk about. We're going to spend the majority of our time today on path 4. The other 3 are pretty nuanced and very specific to what you have. So if you have those situations, I would look into them, and we'll touch on a couple of things in them, because a lot of definitions in those go forward. But the other is that it talks about, it established a reporting standard related to a clarification that BTA models, they should report fiduciary activities. Currently, they're not really reporting them as anything separate. So if you're purely a fiduciary, not purely a fiduciary, but purely a business type activity, you should be reporting that. So you'll be seeing those. A lot of universities and colleges are BTA model and haven't been reporting fiduciaries, but you will be doing that going forward. As I talked about these 4 paths, these are the 4 different ones. It's basically component units or not, and post-employment benefits or not. So those are really the 4 areas we're going to spend our time. The majority of our time today is going to be what we call path 4, which is those all other activities. So here's kind of a flow chart that the GASB put together, whether or not you're in a component unit, yes or no. And then are those assets held for a pension and OPEB arraignment, yes or no? Okay. So we're not going to spend a ton of time through 1 through 3. I do want to hit on a few things as we get towards the end of kind of the technical information related to what those are. So when we talk about some of what those criterias are, when we talk about paths 1, 2, and 3, I'm really going to focus on the majority of, in path 1, this is again your component units, and they are for a post-employment benefit. So it's going to have to meet the definitions it relates to, GASB 67 or GASB 74 or 73. And so those are those fiduciary component units. So that's still, not really a whole lot of change in relation to that. If you're looking at, category 2, right, a component unit, but it's not a post-employment benefit. So where it meets these other types of definitions, and we're going to see these definitions throughout path 4 as well. And this is what we're really going to work through. It talks about the trust arrangements. It talks about who it's directing. Is it legally protected? Are you directing those benefits to other recipients for those benefits? Do you have administrative involvement? Do you have indirect financial involvement? So there's a lot of definitions in there related to paths 2 and then path 4 as it relates to that. We're going to focus on these types of definitions. And so when we talk about administrative involvement, you're going to hear that term a lot. And that to me is really the hardest portion as it relates to the implementation of 84, is determining where that is. And it's not as black and white as you might think. There's a lot of gray. Okay. And so when you're talking about administrative involvement, it's truly whether or not you're monitoring the compliance related to those activities, whether you're determining eligible expenditures, and whether you have the ability to exercise discretion. And I want to zero in on those terms because that's an action step in which you're doing. It's not a passive involvement, it's an active involvement. And so when we walk through the implementation guide questions that are specifically related to administrative involvement and the determining of fiduciary activities, you're going to see that repeatedly. The other question that comes up a lot is direct financial involvement. And that's kind of, are you providing resources of matching funds? Is there some sort of agreement as relates to that? And if you are, you're having a direct financial involvement. Now, there's some questions in that direct financial involvement, whether it's solely versus not solely. And that, I think, is open to interpretation. And you'll see that in our example today. So that path 3, I'm not going to focus on a whole lot, but this is where it's not a component unit, but it still meets the definitions of kind of those. It's for a post-employment benefit, 67, 74, 73, things like that. Okay. So knowing what's there. There was a change that kind of came up here, and I'll hit it right at the end before we get into those. And I know that some people have come up with GASB 97 because there were some unintended consequences of 84, and 97 helped to clarify, but we'll hit that in a moment. So when we talk about controlling the assets, that's kind of, and this is going to kind of really come in with path 3 and with path 4 so much, because it's not a component unit, but the government is holding those assets, and you have the ability to direct the use of those. Now, it doesn't mean that you're making the decision, but you're directing use. You're signing the checks. You're ensuring that that information goes to the people that it needs to go to. So going through some of those basic determinations, this is where we're going to focus our time. Path 4. This is the ones that in anything that you talk about, your agency funds or at schools, your school activity funds and all those kind of things, you know, those treasurers that collect funding for other people, your fire departments, whatever it is, you've got all these different funds that are considered agency right now. This is what we are normally looking at, is those other activities. And so you have to meet these 3 different criteria. And this is what we're going to walk through in our example, is the government. The primary government's going to control those assets. Those assets are not derived either. So this is a double negative, and it's kind of a really hard way to think about it, but the assets cannot be from solely from the government's own source revenues or government mandated non-exchange transactions, voluntary non-exchange, things like that. So when we talk about own source revenue, you're talking about things that the government itself generates. So if you are actively involved in generating that type of information, water and sewer charges, things like that, okay, that is own source revenue. When you're talking about non-exchange transactions, you're talking about taxes, right? Property taxes, things like that that are coming in. Those types of revenues are government revenue. It can't be generated from those items, okay? And then it would need to meet both of those, that it can't be either one. And then the last one has to meet one of those other 3. The number 1, that it's in a trust or a trust-like equivalency or anything like that. And then the last 2, I'm going to read them word for word. I don't really like reading, but the assets are for the benefit of individuals, and the government does not have administrative involvement with the assets or direct financial involvement with the assets. In addition, the assets are not derived from the government's provision of goods or services to those individuals. And then the last one is the assets for the benefit of other organizations or governments that are not part of the financial reporting entity. And again, you can't have that administrative involvement and things like that. So it has to meet all of that. So simplifying that into much more of a checklist, this is one that we've created internally, and we'll make it available to anybody as we go through. But when you evaluate your finance director, whatever position you are, and you're evaluating your activity funds, you have to evaluate every single fund in this manner. Okay. I personally believe about 80% of the funds are not going to change. They're going to be really easy to come up with, exactly where they go. And it's going to be that other 20% that's going to give you a little bit of headache. Okay. And it might not be that high, but that's kind of what it's been so far for us as we've early implemented a few of these, whereas I've seen them early implemented, there are questions that come up to that. Just know they have also given a couple new definition types. So, new definitions for the pension trust, investment trust funds, private purpose trust funds, and then that custodial fund. So agency fund no longer exists. You now have the term custodial fund. Okay. When we talk about additional guidance, you can't implement 84, in my opinion, without the implementation guide. In our example today, the entity actually implemented it before the implementation guide, and the implementation guide gave a lot of clarity and a lot of questions. So anytime GASB has its own implementation guide for an entire standard, it means it's a pretty significant deal. They do implementation guides every single year. They cover a wide range of topics, but, and this one here for 2019-2 is 55 Q&As, effective only for fiduciary. So it covers a wide array of what is considered a fiduciary activity, all the way down to, is this administrative involvement? Is this not administrative involvement? Is this provision of resources and not provision of resources? Okay. There's also a couple really good questions, I thought, in relation to fiduciaries that come up, especially if you're a school district. In the 2020-1, it talks about a ski club and how you direct those funds in questions 4.4 and 4.5. And I think that those are really helpful. So just know that they're out there. I know we all don't have a lot to do. So if you got a few extra minutes, breeze through a couple 100-page standard and some implementation guides, and you can learn all that you need to learn about it. So it's a pretty complicated item, but it's worth if you're really working through some stuff, we'll kind of go through how to do that and where to go to do it. One of the unintended consequences as it related to GASB 84 was really as it came up to something like a deferred comp plan, like a 457 plan. David Bean from the GASB was out here in New Mexico about 2 years ago, maybe a year and a half ago, and he was talking about this at that time. And what had occurred is, by definition, a 457 plan would have become a fiduciary, component unit. Now, that was not GASB's intent. So they had to go back, and he kind of said they were either going to issue a statement saying it's not, or they were going to issue a technical bulletin that said it was. And they kind of issued a statement that said it's not, except in certain situations. So it wasn't as clear as we were hoping. But what it basically does is it establishes this component unit criteria. And so in a 457 plan, there's no board. Okay, so you don't have a board to look at. So they've kind of determined a little bit within those boards, if in certain circumstances, if there's a legally separate organization does not have a governing board for the purposes of those, and therefore you'd have to evaluate it a little bit differently. So it needs to be treated as the same as the appointment of a voting majority of the governing board. So you can't necessarily do that. So the absence of a governing board should be treated the same as the appointment of a voting majority of the governing board. So you have to look at, are you being appointed? Are you appointing this information to people? So you need to look at that. It also talks about the applicability of the financial burden as related to this particular statement itself. Now, that kind of really comes up as how you're administering items through a trust under 67 and 74. Do you have that burden? And then the main thing that they looked at was 457 plans. So what they determined was, in summary, 457 plans, if it's a defined contribution plan, they're excluded from component unit determinations, as there's no separate board. So that excludes paths 1 and 2. Now, on the 457 plans, you have to know the plan. So basically, if it's a defined benefit plan of some sort, you have to know it and evaluate it to determine if it's a component unit. If it's a defined contribution plan, it's excluded. Okay, that's kind of the summation of what 97 did. There's a whole bunch of other information in there if you really need to get down to it. But the main thing I can say is, if you've got a 457, know your plan. Is it defined contribution or is it defined benefit? That's going to be the deciding. That's going to be the do you need to do more work or not? If it's a defined contribution plan, it's excluded. If it's a defined benefit plan, know the plan to determine does it meet the definitions of a pension. If it does meet the definitions of that fiduciary component unit type pension, then it would have to be considered as part of the audit. In my entire practice of 14, 15 years, I've never seen a 457 that's a defined benefit. They've all been defined contributions, but just know your plan. They do exist out there. So that's kind of the overview, really kind of what we're looking for with the technical items of 84. You guys have sat through these presentations for a long, long time. You've heard all of that. Where I find it really kind of the rubber meets the road is when you get into the actual implementation and what does this actually do? So this case study is a real life case study. So it was an early implementation that happened. They implemented it for June 30, 2018. And this is some of the background on it. It was really before the implementation guide came out. The change was only in presentation. So the funds themselves didn't change anything. Okay, they didn't put them anywhere different. They had 4 agency funds, which all became 4 custodial funds. And I want to note that all of these funds were presented as a fund in the statement of fiduciary net position. So they presented them individually in the statement of fiduciary net position and the statement of changes in fiduciary net position. And they had an overall goal. They want this fund in question to be a custodial fund. There's multiple reasons for that, but they wanted it to maintain its custodial fiduciary in nature and not become part of the entity itself. So within the presentation, they actually got a comment on their presentation from the GFOA. And the reason for that is that the custodial funds should be in a combining amount in the basic financial statements, where all those 4 agency funds would have been combined together, or those 4 fiduciaries, with a combining statement in the supplementary information, or what I would say in the back of the financial. So they didn't do that. So when we were looking at it, that was a significant comment that the GFOA said, hey, if you don't fix this, you're going to be precluded from your reward in future years. And they didn't reference 84. They referenced GASB 34. So that's where all that stuff comes from. Now, when we look at what this fund is, had multiple participants. So it's a fund for joint projects. So what they would do is, it's kind of a drainage maintenance facility. So they would be doing a lot of drainage stuff, and they work with the city, and they work with the county, and they work with some other local governments and drainage areas and water treatment centers and all this other kind of stuff. What they would do is they'd have this agency fund where all these other participants would contribute to the projects. However, the main contributions came from this local government, and they were administering the fund. Okay, so they weren't an external participant, but there were external participants. And when I said that they wanted it to continue to be a fiduciary fund, it's because they had agreements with 2 external governments that would require that a fiduciary fund would be set up in order to administer those projects. So anytime that you would have that, and so this is some of the examples, right? So they had an external participant would contribute these funds for a joint project. So the city might provide $40,000 for a portion of a sidewalk and has this drainage group do. So the drainage group might be working on some arroyos and own the arroyos. And then the city comes in and says, hey, here's $40,000. We want to put some sidewalks there. And that's what this fund was for. And so this local government's working on the drainage facilities and things like that. They provide some of their own bond money to fund the joint project. So they're taking some of their money, they're putting it in there, they're moving it over into that fund. Okay, and they're administering that project and utilizing the funds from around the city and the county and all the above. So from the administration side, what this local government's doing is they're the local government that's holding the cash. They're receiving the funds that are received from the other participants, and they're making those payments. So they're administering those processes, right? So the money comes in, they put it out, they're doing the work, et cetera. Now, the local government would oversee the procurement process. And one member of each of the participating entities, so whether it was the city or the county that's involved in the project, a member from each of those areas would participate in the decision-making process in the bid or the RFP process in order to conduct these. And then, as well as part of the approval process, when an invoice comes in from a contractor, they actually would go ahead and put out the project invoices would go to the other participants. Okay, so the other participants, the city or the county, would actually get invoices in order to approve them. So that's kind of the overall background. So we went through our quick assessment, which, by the way, was not so quick. It probably took about, 6 to 8 hours to be able to do over the course of a day in the field. So I say quick assessment because we went through this process. Now, I'm going to give you all of that. What we're going to do with our poll questions today is we're going to kind of fill out this form together. And we're going to go through what these are. So I want you to know from this perspective, I came in, yes, as an independent auditor, knowing what my client's overall agreements were, knowing what the client's ideas were of what they wanted to accomplish. And I wanted to be an advocate for my client. Now, I was going to, of course, maintain my objectivity, and our firm was going to do that. But we were also going to try to say, hey, you want it to be this way. Let's see if this is going to work and how we get there. And we'll get to there at the end. So what we're going to do now is we're going to go into our first polling questions, and I'm going to let David go ahead and launch those.
Okay, so polling question number 1. So based on the fact pattern that AJ just laid out, does the government control the assets? So A, yes, B, no. So we'll give everyone a couple of seconds to make sure we all get our answers in for CPE. So AJ, I don't know if I want to spoil it, but now with the implementation guide, do you think you would have ended up somewhere different?
So the way I can actually say this is I took this job over, so it was implemented in 2018 prior to the implementation guide. And when we went through the assessment, we actually did this assessment in 2019 and ended up in a different place. Okay. So, but you've got to understand kind of the way we went there with the overall goal. So, but yeah, when we took this job over in 2019, there was new information to provide that. So I don't believe the prior people did anything incorrect. It was just a matter of the knowledge and what's out there.
Right. Okay, so I'm going to go ahead and close it. Looks like we've paused out on answers. So we'll share the results.
All right, so 78% say yes and 22% say no. And so, you know, this one here really comes down to yes, they do control the assets simply because they are the ones that are holding it and they have the ability to direct the use and things like that. And that's one of those definitions that's in there, but that's perfectly fine. The ones that we get to a little bit later, there's going to be a whole bunch of questions as it relates to what are we truly looking at. Okay. Now, so when we had to come down to what those control pieces are, we already asked that question. The government controls the assets of an activity if they hold the assets and they have the ability to direct the use. So in this situation, because they're the ones that are physically signing the checks, just because the approval items are going somewhere else, they're holding them because the city deposits the money into the drainage facility area. They hold those, they write the checks, and they're following that guidance. So they are actually controlling those assets. Now, when we get down into the test 2, into revenues, are the assets derived from own source revenue? So this is where we start to get into a little bit of more of the, what I call the gray area, or the quote unquote creative accounting, is with own source revenue, are they generated by the government themselves? Now, some of the money that goes in from this drainage group is some of their GO bond money. Now, GO bond money, it does not say, that doesn't necessarily meet the definition. So I'm trying to be, again, an advocate for our client here. GO bond money doesn't necessarily meet the direct definition of non-exchange revenues, imposed non-exchange revenues. Property taxes do, and indirectly, bond money is an advancement on property taxes. So maybe we can get there. Okay, it's not solely their revenue, because it's not just from this government. The city's putting in some money, but they do contribute some. So when we started going down, one of the questions we came up to is, does the bond money count as own source revenue? The implementation guide does not specifically address bond funds. And the bond revenue, again, as I said, is an advancement of property taxes. So property taxes are an imposed non-exchange transaction or non-exchange revenue. So we're going to do another poll question here based on that fact pattern. Are the assets derived from their own source revenue?
All right, so another yes or no question for everyone. It seems like we're going to be having these same discussions quite a few times with this implementation.
You're going to. I have done this presentation in this manner 10 times probably in different groups. And I don't know if we've ever gotten above 2/3 agreement in any direction, which is fine. I personally like to exercise where there is no guidance. We have to work together to come to an agreement.
Makes it interesting though when you think through how much GASB hates diversity in practice. That people can use the same fact pattern and good judgment and get to different answers.
what I find so fascinating about this statement is that it is clarifying 34 and didn't clarify a whole lot.
All right, so we're just about kind of paused out here on new answers. I'm going to go ahead and end the poll.
Okay.
And share our results.
56% say yes, they are. 44% say no. That's about what I expect. I thought this was going to be about a 50-50, and I don't think I've ever had above 2/3, like I said, one way or the other. So I appreciate that. As we said, there are no right answers right now. So we're going to get through kind of the whole process, and we'll kind of talk about it and summarize it. So really, when we get down into this test 2, when we need to talk about government mandated or non-exchange transactions, we talked about it being own source revenue. Was it their own revenue? And now we have to discuss, is it non-exchange? Again, it's GO bond money, not necessarily anything when it comes to the property taxes specifically. So with poll question 3, are the assets derived from government mandated or involuntary non-exchange? Very similar questions with subtle differences.
Yeah, we end up coming back to so many GASB technical questions on kind of their 4 definitions of revenue, really 4 main types of revenue: of government mandated, voluntary non-exchange, exchange, imposed non-exchange. We get those terms quite a bit these days, it feels like.
And I don't know if anyone's paying attention to what's going on with GASB, but they're doing a project over revenue right now anyway. So you're expecting that with a large, you got 3 big statements that GASB is going to be putting out in the next couple of years related to that kind of stuff too.
All right, so again, just make sure you're answering the questions. It doesn't matter if you answer them correctly. Although in these questions that AJ's put together, I'm not sure there is a correct answer. Just important that you respond for CPE. So about 87% voted. Go ahead and end the poll.
61 yes, 39 no. So I think everyone's in that 60-40. Again, that's kind of what I expect. So my personal opinion is that test 2, based on when we were going through this, I told the client, I don't believe test 2 was met, because I believe really, to me, it was more the own source revenue, because there's a good portion of that funding that comes from them, and the city's not required to put anything in there. Now, I didn't tell you that the city's not required to put anything in there. They have these agreements, but there are times where the city's not going to do anything and the county might not do anything. So I personally didn't believe that the test 2 was met, but I said, okay, client, we're going to work through it. I'm going to take the stance that it was. Okay, that we can make the argument. So we did some more defining and some more research to really determine, okay, what's next? All right. So the question really came down to, is this a trust? Based on that fact pattern, does it meet the definition of a trust where there's some sort of trust agreement, an equivalent arrangement, where the government itself is not a beneficiary, dedicated to providing benefits to the recipients in accordance with benefit terms? And are they legally protected from the creditor? So was it this separate agreement? Is really that we're onto that section 3, really on that poll question of, is this a trust?
So our fourth polling question was rolling through these polls. Rapid fire. You would typically think that this question is an easy one, and the fact pattern you've laid out, it's not as easy as the trust question normally seems. When you kind of sit through these presentations, and if you do a little bit of research, it seems like the trust one would be easy to answer, but that's not the case.
Right.
All right, give everyone a couple more seconds to get their answer in.
And 50-50. So the answer is actually, it's no, it's not a trust. It's not legally protected. It's voluntary. It's not anything like that. There's no sort of equivalent arrangement or anything along the lines in which really you're saying that that would meet that definition. So it only has to meet one of those last three on that checklist. So what we decided is, okay, we're gonna have to start looking to say, what's it for the benefit of the individuals, because the participants themselves are all local governments. They're not clubs, they're not individuals putting something in. So my client says the general public is the beneficiary of the projects from public safety. Not to mention they get paths, they get walkways, things like that. So the individual is the benefit. Okay, we'll take that stance. We'll kind of think, does that make sense? How does that work? So let's devil's advocate here. Let's say that it meets that definition and that the general public is the beneficiary. So we have to really get down to, are you administratively or direct financial involvement? Does your local government have this definition? And just so we're aware, it's not derived from the government's provision of services, right? So it's not from anything that they're creating, it's from this bond money. So when we're looking at this direct financial involvement, we have to go to these different questions. Now, I'd like to say that the GASB had the exact question I needed in there, and of course they did not, right? So what we had to do is we have to use a little bit of that knowledge to understand what are we really trying to do and read a whole bunch of questions. The guide is laid out by section. And really what I needed here, we really needed question 4.22, but 4.22 says it's the same facts as in 4.21. And so I wanted to zero in on a couple of these implementation guide questions, because this is the format that they go, and this is the exact process we walked through. So the process we walked through says, okay, the school board's this is for a school board. They establish this policy that's going to say that's related to the disbursement of these funds for these different clubs. And these funds are not legally separate from the district. The policy includes specific guidelines related to how the funds raised can be spent. So the question here became, does the district have administrative involvement as defined? And the answer is yes, because they've established these specific guidelines. Okay, so I said I needed 4.22. 4.22 says it's the same facts as 4.21, except that the policy only applies to all clubs, but only addresses issues such as the authorized account signers and the prohibition of spending for illegal activities. So when we talk about these are kind of polar opposites, right? In 4.21, it's specific guidelines. And in 4.22, it's, hey, you're not buying alcohol and the right people are signing the check. And so that's kind of where we're at. So this is not administrative involvement. So the interpretation as it relates to our client, it's in between those. They don't have a vague policy like is noted in 4.22, but they're not putting in specifics like 4.21. So what they're doing is they're overseeing items like procurement for compliance and making sure that it's being followed, but they're not, but other people are involved in that. However, if it's under the threshold for a bid or an RFP, there's no direct involvement from the other participants. So we say, okay, probably not, but let's move to another question. All right, so when it's under this other question, the question we get down to is related to a public university. So they receive these funds, it controls from the program itself. The university is responsible for selecting the scholarship recipients and monitoring the recipient's compliance each semester. And so really here it was, does the university have this this administrative involvement in the scholarship program? And the answer was yes. So in this scenario, because they are determining the eligible scholarship recipients and the monitoring those recipients for compliance. So what we kind of determined here is that based for our client, they're not determining procurement on the large items, but they are on the small. So they're making that determination on the small items, and they're monitoring the compliance with laws and regulations. So they're ensuring that you followed procurement, that it goes to the right people, the right forms are in there, you got the quotes and all of those types of things. So when we kind of looked at it, we said, is there administrative or direct financial involvement? Well, we said it's not a vague policy like in 4.22, but not specific, and it's overseeing those items for legal compliance. Okay, so for me, when I looked at it and I kind of took, GASB doesn't say that you have to have like what threshold necessarily. I kind of went back to my business law class and said, hey, under the preponderance of evidence, I'm going to lean no, that this does not count. So we thought, okay, well, let's continue talking about the next test? Is it for the benefit of other organizations? Because that second question is, does it relate to the individuals and things like that? The last one is benefit for the other organizations. So is it for the benefit of those other organizations? There are other organizations that are part of this group of people. However, the participants are other governments, but also themselves. They're not derived from the government's provision of services. So we work together to determine the government's provision of services, and we considered multiple implementation guide questions because they are a beneficiary. They're not the sole beneficiary of this type of item. So when we thought about what is really going to work, how do we know who it's benefiting? So we went to another question, 4.27. It goes back to a university. That the funds received from a foundation that's legally separate, the foundation is not a component unit of the university. So this would be like the city is another entity, it's legally separate. They're not a component unit of the drainage facility. The funds are for the sole purpose of granting science and engineering scholarships. The foundation's executive director, who's not a university employee, selects recipients based on the criteria established by the foundation. Recipients are not required to attend the university. If a scholarship is awarded to a student of the university applies the scholarship amount to that recipient student account. So what they're asking here is determining whether those resources controlled by the university are fiduciary. And in this fashion, they are yes. Okay. The university is holding those resources for the foundation. The foundation is a legally separate entity, not a component unit, is not part of the university's reporting entity. The resources are not derived from the university's provision of goods or services. So when we kind of interpreted this question, we really had to look and say there's contributions by others, but they're at their discretion. So the city can choose or not choose to contribute to this entity. They can do a project at their will, but there's no requirement to do so. Again, the projects are partially determined by others only underneath the bid in the RFP, and the other participants are not employees or at the discretion of the local government. So the other governments are really the participants. They're not employees of those. Okay. And then the majority of the revenues are still their own funds. So the majority of this money is the bond money that's coming from the drainage facility. And, it might be $1 million versus the 40,000 the city's putting in. So when we kind of looked at that question, poll question number 5, we're kind of going back a little bit, but is it for the benefits of individuals with no administrative or direct financial involvement?
Again, as you said kind of at the beginning, AJ, this is really the biggest question and probably the toughest question in this standard.
Question. I think it is.
You could really go back and forth on the administrative involvement portion. So again, just make sure you get your answer in for CPE credit. AJ, did you have anyone implement 84 last year? Did everyone accept the 1-year delay?
I didn't have anyone implement it last year. I've seen, so this particular client, we took over in 19 and it had been implemented in 18. And then there was another one that we took over in 2020 that implemented in 19. And that was a school district. And that one, they did all of this part right, but the presentation was actually off. And that's why I want to make sure we don't miss the presentation, because it's something that if you haven't done it before, it was off. So I've seen it early implemented twice. And in both circumstances, there was a correction and a restatement made, unfortunately. So it's not easy.
Yeah. All right, so I'm going to go ahead and end our poll.
So 67% say yes. And so I'm not going to say where I fall. And we're going to do the last question, which is kind of that number 6. On that checklist. So is it for the benefit of other organizations or governments and not derived from the government's provisions of services? So the participants are other governments And again, it's not derived from the government's provision of services as noted in 4.27. The other participants are not employees of or at the discretion of the local government. So the question comes down to, sorry, I thought it was on the poll question. I needed to go a little further. Poll question is going to be, is it for the benefit of other organizations or governments and not derived from their services?
So I guess you've been kind of meant to teach this standard. You got an early implementation that had ones that have now led you to teach it for years. So
the most fascinating thing about it is I was set to present on GASB 84 in October of 2019. And we worked through this problem with this client probably 3 days before that presentation. And I redid my entire presentation because it gave an entirely new understanding of what it means. So if you haven't worked through it, it's tough to work through. You have it conceptually, you have it thoughtfully, you really think about it. But if you've really worked into the information and into the details, that's where it really starts to become a little, I should say a little bit more clear, but also a little bit more fuzzy.
Right.
Because we all think about it as, oh, it's going to be pretty simple. It's not necessarily that simple. Now, if the state, going back to those 4.21 and 4.22 questions, 4.23 is the same fact pattern, except the state establishes a requirement. If the state establishes a requirement, it's administrative involvement, and therefore it doesn't qualify as a fiduciary. So just anyone that's in a different state, you know, I know someone was asking a question recently, and I know there's been some confusion, specifically, David, I think in the state of Florida, where one district wants to do something, one district says it's something different. There's a lot of back and forth, and that it's really, and they're saying that the state's putting this information. If the state's doing some things, like, you know, we can work through those, but 4.23 specifically addresses administrative involvement as it relates to state requirements.
Yeah, in Florida, we definitely, we have guidance on our school boards on state involvement. There is guidance at the state level, which makes it challenging on advocating what the Q&A that GASB put in on state involvement. So I'm gonna go ahead and end our poll here, share the results.
About 67% say yes, and that is about the highest number that I ever see. Is about 2/3 go one way and I've seen this question go 2/3 the other way too. So yes and no. So sometimes it's my teaching and sometimes it's not. It's just kind of a matter of working through them. So when we really get down to, is this a custodial fund? This is where we kind of get to. Are we still sharing the poll results?
Sorry.
That's okay. So this is kind of a slide that kind of looks over those. These are our 6 poll questions that we did, and I'm going to show it on our checklist that we had done. Okay. So our final outcome really comes from our client and auditor judgment. So this is what we worked through with the client. Okay. Test 1 control. Yep. That's the easiest one. They hold the assets. Test 2, we said gray area, lean no for both of those. We lean that they do not meet that test. Test 3, yet no, it's not a trust. And lean no on those other 2. Again, I go to that preponderance of evidence, kind of that 51%. The ultimate thing was it does not qualify as a custodial fund, needs to be adjusted to be a capital projects fund. They also had to work with their participants to update their agreements because it's not going to be in a custodial fund. And they needed to budget and report for it differently because in this state where they are working, they actually had to budget. They have policy that they budget all of their funds that are non-fiduciary. So they had to actually change some things. This is really what it came up to on our checklist. It met 1, all the others we said that probably not. Okay. So what came from it was that restatement and it changed. So we walked through that, and I know a lot of people were kind of back and forth. We had about 2/3 said that it would have met those bottom 2 questions, 50-50 on the trust. The own source revenues was about 2/3 one way versus the other. So it's a complicated process. You have to go through this with every fund that you have. Now, there are some, if you're a county and you collect taxes for other people, that is specifically in the guide that is custodial. That's not considered anything else. It's a custodial fund. They're not your assets. You also have a lot of different situations like that. You also have, like in my state, in New Mexico, if you have a state agency, agencies are kind of like a fund of the overall government. And GASB's guidance says you have to consider it from the overall reporting unit. Just because you have an audit at a different level, it's really what is it at the state level. So there's a lot of questions like that you have to work through. So I definitely, you're gonna get this right 80% without trying. That other 20% you're gonna try, and it's gonna be tough. And so when I can happily say that our client got to the same answer we did. It just took all day. We walked through it. We went through everything. I sat down with the engineer. I sat down with the executive director. I sat down with the finance director. There's 4 of us in a room walking through these different things and all these different scenarios and observing the documents. So that's something just to be aware of and kind of what that looks like. As I mentioned, one other one, and I've got some examples of what the presentation is going to look like for a couple of school districts here, but the presentation is also different. The opinions are different. The audit work is actually going to be different. So when we look at what 84 says, currently under our presentation, we have a basic financial that has a statement of fiduciary assets and liabilities for the agency funds. And we have supplementary information that's related to the schedule of changes of fiduciary assets and liabilities for the agency funds. Under 84, you're going to have a statement of fiduciary net position and a statement of changes in fiduciary net position. Agency fund doesn't exist anymore. Both of those are in the basic financial statement. So if you didn't have any of those fiduciary component units, private purpose trust funds, investment trust funds, things like that, you never had what I would call an income statement as it relates to fiduciaries, but you will now have quote unquote income statement for that. In the back, in the supplementary information, you're going to have a combining statement on fiduciary net position and a combining statement on changes in fiduciary net position. So you're going to have those combining funds by fund and roll up all of those custodials in the basic financial. So what that looks like is we've got some changes, and I want to focus really on that statement of changes of fiduciary net position, because your additions and your deductions, so revenues and expenses, are now going to have to be disaggregated by source. So you can't just put additions and deductions like used to be in there in the supplementary information. You have to break it out. So you're going to have different charges. You're going to have investments, investment earnings, whatever they are. And same thing with the deductions themselves. Okay. So you're going to have that disaggregated presentation. So the presentation's different. So in theory, the audit work is also different because our opinions have changed. So currently, as it relates to that statement of changes in fiduciary net position, currently we have an in relation to opinion, that schedule in the back. So it ties to the one in the front. It's fairly presented in relation to the financials as a whole. On the basic financial, under GASB 84, there's an audit opinion. So we're actually going to be having to test revenues and expenses that are related to that actual, that are related to those activities. You're going to, and the financial statement presentation and all the above, those all have to make sense. So when we look at what the presentation looks like, so I picked on a couple of school districts. So this is pre-84, okay? So Deming Public Schools here, district in New Mexico. This is their basic financial statement. This is all public information. You can go out to the website, go get it. But this is a 2020 financial statement that has not implemented GASB 84. They've got assets and liabilities that equal each other, okay? That's in the basic financials, the statement of fiduciary assets and liabilities. And there's supplementary information as it relates to the different activities. It's kind of a roll forward, right? The different activities, the cash, the liabilities, the additions, the deletions, and what those totals are at the end. And that's what the statement currently looks like. So I had mentioned that there was an early implementation of the school district. So I want to kind of show apples to apples, close municipal schools. This is an early implemented, this is 2020's financial. And they've got their total assets and they have their liabilities. And then they have that whole new section down on the bottom that's net position that's restricted for student organizations. So that net position, so those, not everything is a liability anymore because there's not truly a draw on resources. There's not a current call on anything. They're not due and payable. There truly is net position there. So this is part of the basic financial statement. This is also part of the basic financial statement. Here's that income statement I was talking about. The statement of changes in fiduciary net position. So you've got your additions, your charges, and then investment earnings, and you've got your current deductions. Those are based on the function units and things like that. The actual categories of the statement activities, and then you have your transfers that they had, and there's their restatement. So when you implement the statement, you're gonna have a restatement because you no longer have liabilities. A lot of times they go to net position. So I would anticipate when you implement 84. If you don't have a restatement because of it, You need to truly evaluate whether it's done correctly on the implementation side, because again, I've seen it wrong in practice. So we want to make sure that it's done correctly. And then I talked about combining statements. So this is the combining statement of fiduciary net position, which is sitting in the supplementary information. So it's a fund financial statement. So this is just page 3 of 3. This statement's probably 30 funds long, and it's all these different schools or the support centers or whatever, and they all kind of, you know, total up to what those statements are in the front or in the basic. And then you've got your statement of changes in fiduciary net position as a combining statement where things are going, and that way it ties to that statement, just like any other basic financial. When you have combining statements, you know, combining balance sheet rolls up into that non-major financial statement, that non-major funds and the basic financial. This is doing the same thing, just at a fiduciary level. And with that, I am done with 84. I am going to turn it over to Ms. Becky, who's going to take us through leases and some applications on that. David, do we have any questions or anything as it relates to anything we need to take now before we transition?
No, we don't have any questions now. We got some in during the registration process that we'll do at the office hour portion at the end of the presentation.
Perfect. Well, I'm going to turn it over to Becky. So thank you guys very much.
Hello, everyone. Sorry about that. Had a moment of technical difficulty, but thanks so much, AJ, for that awesome presentation. It's really helpful to see a real live example of GASB 84. I've worked through it on a few of my clients as well, and it's definitely a challenge, and you definitely have a tendency to overthink everything as you're going through the different checklists and trying to understand it all. So I am pleased today to present to you some information on GASB statement number 87, the leases standard. This one's been a long time out there. We've heard lots of presentations on it as well. And unfortunately, it's not quite here yet in the sense of we technically don't have to implement it until next year. But in many cases, we are already having to get this together, and we need to be implementing it from a procedural perspective, as well as if we have comparative financial statements, we need to be getting this information together as well. So the objective of this standard was to establish a single model for lease accounting based on the principle that leases are financings of the right to use an underlying asset. FASB and IASB conducted a joint project, and they updated their lease standards. And so GASB felt that there was definitely a need to follow suit with that, so that there was some consistency across all of financial reporting. This standard is effective for fiscal years beginning after June 15th of 2021, which would make the first year ends required to implement the June 30, 2022 year ends. So this is coming up quickly. I think there are a lot of our clients that really haven't thought through it a whole lot yet. And that's a little scary, because this, just like the GASB 84, is a pretty robust standard, and there's a lot of things that we need to be prepared to do. So just some things to focus on as soon as possible, starting off with your any leases that are lasting more than a year are going to have to be reported as long-term liabilities. So that's going to have an effect on your debt limits and possibly your bond covenants. So you need to review any of those laws and agreements to determine if there could be an impact on compliance that you need to discuss with those bondholders or with lawmakers. So make sure that you're kind of looking at all of that and focused on it. The other big thing that you need to be doing now is looking at your policies and procedures. There may need to be a change to your policies and procedures for tracking and reporting leases. We've seen in a lot of cases where the leases are not necessarily centralized as far as their tracking. And so a lot of different departments are handling different pieces of all of the lease part, and that can be a challenge. So you need to be getting that together in one place now, communicating between your departments, and centralizing, your accounting staff to make sure that you are tracking and making sure you have all the information together for all of the leases that are in your universe. These procedures need to identify when the lease agreements have been initiated, and when the existing leases are modified, so that you can determine if there are changes that need to be made to the accounting. You should also review your capital asset policies, capitalization thresholds and things of that nature, in light of the need to report this intangible right to use asset, and make sure that all of that is in line. So as far as the transition provisions, I kind of put up some dates. I know we have some different year ends for our listeners today. And so I wanted to give you kind of an understanding of your kind of drop dead implementation dates. So for single year presentations, if you're a June 30 year end, then you're going to have to implement this in June 30 of 2020 with going back to the beginning of your period, July 1st, 2021. So you really need to be here in the next 2 months coming up with what are your policies and procedures and get those in place during the year that you're going to need to be implementing this. And you can see for September 30 year ends, you've got till October, December 31st year ends, you've got until January. So this is coming up very quickly here in the next several months. For comparative presentations, you really needed to already have gone back to last year or the beginning of this year, depending on your year end. So just if you haven't started moving yet in your comparative presentation, you definitely need to get rolling with the things that you need to do to prepare for this standard. So I'm just going to kind of quickly go through the standard, the scope and the approach of it, and what that definition of a lease is. It's a lease. A lease is a contract that conveys control of the right to use another entity's non-financial asset, which is the underlying asset, for a period of time in an exchange or exchange-like transaction. So this concept of right to use is a core concept in this standard. The GASB has done away with the operating and capital lease scenarios that we were under before. And now it's just a lease or a short-term lease. But one thing to remember is that just because your document is not specifically called a lease doesn't mean that this standard does not apply to it, which is why there's a lot of contract language in here. So this single approach is now going to be applied to accounting for leases. And there are a few little exceptions, such as short-term leases. And we're going to go over those exceptions and exclusions as well. So you can see here, these are the scope exclusions that were included in the standard: intangible assets, biological assets, inventory. If you have a service concession arrangement, that's just going to fall under GASB Statement 60, so no change there. If you have any assets financed with conduit debt, that remains under that standard. And then supply contracts are also separate. Some less common inclusions and exclusions that the implementation guide put out. Certain things like cell towers and grazing leases are actually included in the scope. A big maybe, and where you'd have to analyze a little bit more, is things like land easements and right-of-way agreements. And then specifically excluded in the implementation guide is airspace and any hunting road use type permits. So if you have something in the permit space, you know that you can go ahead and exclude that on the front end. So in trying to put all of this into some kind of format where we could a little more easily kind of go through a checklist and determine whether GASB 87 even applies to my lease or contract, I kind of put together some questions that the way that we have this laid out will allow you to kind of exclude, if you're able to exclude your contract from GASB 87, exclude it as quickly as possible, so that you're not answering a lot of all the detailed questions if it's something that falls outside of the scope or doesn't meet the definitions that are in the standard. So the first question you need to ask yourself is the contract for services? Now, you want to make sure that you don't have a contract that kind of has a lease and a service component combined, because then you're still going to have to keep that in your universe. But if it's solely for services, you can exclude it. The next item is if it meets the definition of an investment under GASB 72. So if it's a financial asset that meets that definition, you would exclude it. And then if the lease is specifically excluded, which was that previous list that I showed you right here, if it's any of those items, you know that you can go ahead and exclude it before you even really get started. The next piece is to determine if there is a finance purchase that meets the definition of GASB 87. So these are the questions that you need to ask in relation to that. The first is, does the contract transfer ownership to the lessee by the end of the contract? This would also apply on the lessor side too. And then if that's the case, does the contract have any termination or fiscal funding clauses? If those fiscal funding, cancellation, termination clauses are reasonably certain not to be exercised, then you could call this a finance purchase. So you really just need to understand, is it possible and reasonably certain that there's going to be some kind of cancellation or termination? If it's going to be canceled, then it can't be a finance purchase. But if you're pretty sure that it's going to happen that way, and it does transfer that ownership, then it's considered a finance purchase, and you would record that just like the former capital lease scenario that we used to record under. Now, once we get further into the GASB 87 standard, there are some other questions that you need to ask yourself in regards to your contract. The first is, do you have fixed or fixed in substance payments? If all of your payments are variable, then it's pretty difficult to determine how you would account for that on the front end. So you wouldn't be able to do the accounting related to the standard. So those payments have to be fixed. The next piece is, do the parties receive and give up essentially equal values? So if you have a situation where you've got a dollar lease, or even a lease that's $1,000 for a year, that tends to, you kind of have to evaluate that and judgmentally decide, is that really a lease that has equal value between the two parties? And if it doesn't, then it would not be subject to GASB 87. The next is, does the leasee have control of the right to use the asset? And you've got to look at both, does it obtain the present service capacity, and can the leasee determine the nature and manner of the use? And so there's checklists specifically on all of this. There's a lot of definitions involved. So this is similar to GASB 84, where you've got to really go in and assess how that fits with your specific circumstance. That's the same case here. So, and there are tons of questions in the implementation guide that kind of go over that. And I think as we start to do more of these, there'll be more information out there in order to determine the answers to these. The fourth item is a big one that everybody wishes that their contract could meet the definition of a short-term lease. And so if the maximum lease term is greater than 12 months, and that has to include all options to extend, then you would have to include it in GASB 87. And then the last question, I'm kind of going to flip the terminology here because it's kind of hard to process this from a yes answer perspective, but is your contract term indefinite? And what I mean by indefinite is you can't have cancellation options that are probable that will happen. So if it's indefinite, you really can't calculate indefinite. Therefore, it wouldn't be subject to GASB 87. But if it's not indefinite because there's some way to get out of it, then it would apply. So for short-term leases, again, the maximum possible term under the contract is 12 months or less. And if this does meet that definition, then you're going to recognize the expense or the expenditure, depending on the fund that you're recording it in. You will not recognize any assets or liabilities associated with the right to use that asset. This is a tricky area. There are a lot of contracts out there that are trying to be written to allow the parties to be able to say that you have a short-term lease. So you really need to be careful and read the language specifically if they're trying to purport that it's a 12-month lease, because what we're finding is that there are a lot of leases out there where the client tells us, oh, it's definitely a 12-month lease, so we don't have to record it. And then we get the contract and realize, no, they've got some kind of renewal option or something that very clearly states that it is. So just be careful with that and make sure that it does indeed meet the definition and is a true short-term 12-month or less lease. For the lessors, you would recognize the lease payments as revenue as you receive the payments based on those payment provisions. There won't be any recognition of receivables or deferred inflows related to that. So basically, if it's a short-term lease, you're just doing short-term accounting. If it's a long-term lease, then you've got to do your long-term accounting. So here we have our first poll question.
So a short-term lease has a maximum possible term under the contract of there's no such thing as a short-term lease. The maximum term is 12 months, 3 months plus all cancelable terms, or 6 months. Just make sure you get your questions in. Becky, one quick question that came in through the Q&A at the bottom that everyone has access to. When you were talking about what types of leases are included or excluded, would 87 apply to software licensing?
So the software licensing piece is actually covered under GASB 96, but the concept of it's very similar. So I would think that you need to look at your contract to see if it meets the definition of GASB 96 with the subscription services, then it would actually fall under that. But that's not all dissimilar from the concepts in 87. So the answer really is it depends. You need to look at that contract to see does it meet those different definitions.
All right, so I'm going to go ahead and end this poll, share the results.
So of course, 92% said 12 months. So I was trying to give y'all a break after AJ's racking questions. So, but yeah, it is 12 months is the maximum possible term. All right, so the next big piece of the standard that I think we need to be careful how we're applying it is materiality. As with all GASB statements, the provisions of this statement need not be applied if your items are immaterial. And so you really need to consult with your auditor and look at all of the information that you have and look at your list of leases to determine, well, what does immaterial mean? because what we're concerned about here is that these items don't add up and aggregate to something that is material. And so that answer is going to be different for each government. And so you really need to look at, what are the chances that you could have enough small items that could be material. So what we did in consulting with a lot of our clients already was we got a preliminary list and looked at it and kind of sorted it and added some numbers up and compared that to the materiality that we're using in the audit. And remember, if there's a fund thought process in that, you may have some materiality considerations from a fund level when you record some of that activity in each year. But you really just gotta look at your situation and establish basically a capitalization threshold for your entity that also includes a materiality, and basically just say, if my lease value is under a certain amount, then we're just going to record it, as a short-term accounting and not worry about recording the liability. So again, I think you need to use this very carefully. And the standard does allow for grouping of lease activities to ease the disclosure burden. So, when you're looking at the materiality piece of it, you can look to see, are there leases where you could group them and do things that would ease the presentation. Another big issue that we're seeing in leases is what's called embedded leases. And these are contracts where there's both a supply contract and a right to use an asset built into the same lease. We see this a lot with IT service contracts, as a service contracts, sales, supply, advertising contracts, transportation and construction arrangements, and related party transactions. So you really need to review those leases, those contracts, and see what's intended to result in that contract. Normally, a supply contract doesn't convey the right to use an underlying asset, but there are some situations where that could be the case. And so here are a few of them. If you have a cafeteria contract where there's freezers involved, or soda fountains, water coolers, coffee machines, any of those types of contracts. Now, a lot of times those could be immaterial, but if you're putting coffee machines in multiple locations all over, you could start to aggregate those leases and have an issue there. So you still need to kind of address, does this factor in to your materiality? So just make sure you're looking at to see, not only are you getting the soda, but is there a fountain where you're using an asset as well in this scenario? So just make sure that if you're unsure, you definitely get those leases and really use your judgment. So when you find out that you do have a lease where you have both lease and non-lease components, you need to be able to separate those pieces. Another example is a copy machine where you have toner cartridges in there. So you need to be able to separate the copy machine from the toner cartridges. You also need to take out any non-lease components, any maintenance, CAM, utilities, those types of items. And then allocate the contract price based on the reasonable individual prices for each of those components. You want to also maximize the use of observable information if you have to estimate. Whenever those individual prices may not be available or unreasonable. So it's okay to estimate if you can, get something that's observable. And then if you are estimating, you may be able to account for multiple contracts as a single lease unit, only if the estimating is not practical. So you really need to look to see if you can't, then you can add some things together and treat that as a single lease unit. Now, one of the big challenges in the standard is to determine what the lease term is. So remember, we're going to start with the non-cancelable period. And for purposes of implementation, we're only going to start with, the first date of the beginning of the period of implementation. So we don't have to go back in time and look back years and years and years to all of the leases. So we only need those leases that were in effect at the beginning of the period that we're implementing. Now, remember, if you're doing comparative financial statements, you need to include the beginning of the period of the first year of presentation. So you may have to go back 2 years in the whole scheme of things when you're looking at this. So when does our lease start and end? Remember, we're going to start with our non-cancelable period that's in the lease agreement. So in this case, we start in 2021 and it ends in 2027. Then we're going to add any periods covered by options to extend if they're reasonably certain to be exercised. And we're going to include any options to terminate as long as they're reasonably certain of not being exercised. So you just have to evaluate those termination clauses to make sure they're not going to be exercised as part of the lease. You would exclude any cancelable periods. So if you have anything that's rolling month to month, then those wouldn't be included. And then you would ignore any fiscal funding or cancellation clauses unless there's a reasonable certainty of being exercised. So you just really need to look at those clauses, and if they are reasonably certain to be exercised, then that is going to have to change your ending result. So as far as the initial reporting, for the leasee side, we're going to record an intangible lease asset using the value of the lease liability plus any prepayments and initial direct costs that we need to put the asset in service. And then we're going to record a liability using the present value of the future lease payments. And those lease payments are going to include any fixed payments, any variable payments where we have an index or a rate to calculate, and in any reasonably certain residual guarantees. For the lessor side, we're going to record a lease receivable, basically the same items as the lessee liability. And we're going to continue to report the leased asset if we already had it on the books. And then we're going to have a deferred inflow equal to the lease receivable plus any cash you received up front that relates to a future period. Now, any initial direct costs that are considered to be debt issuance costs should be expensed. In the statement of cash flows, any payments should be classified as financing activities. And if you have lease incentives, those are going to affect the measurement of the lessee's lease asset and liability or the lessor's receivable, as long as they're known amounts. So make sure that you're considering that in the initial reporting as well. For initial direct costs, you'll need the costs to originate the lease. And those are going to include any cost directly related to specified activities performed by the lessor. So if you have to evaluate the financial condition of the lessee, any recording of guarantees, collateral, security arrangements, preparing the lease documents and processing that, negotiating lease terms, and closing the transaction. Those costs can all be included and should be included in the details to record the accounting. Now, one of the big questions that we've gotten a lot of is on the interest rates in order to calculate present value. So the present value is going to be determined using the interest rate that the lessor charges the lessee, if it's stated in the lease, or a rate implicit in the lease, if there's a way to get to that point. If not, and you can't readily determine that, then you would use the incremental borrowing rate of the lessee. So we've gotten a lot of questions on, well, what is the incremental borrowing rate? And I think the standard gives you a lot of judgment with which to determine that. What we've been telling our clients is to look at, a lot of them have done a bond issue recently. And so it would make sense that they would use the percentage from the latest bond issue as their incremental borrowing rate if they can't determine a specific rate for each contract. So just make sure that you're looking at that. You'll want to establish that on the front end so that you already have that determined. As far as the lease liability, as I said before, it is the present value of the future lease payments less any lease incentives. So you need to make sure that you're including all the pieces and parts that can be determined from the contract. So if there are any amounts that are reasonably certain to be paid as residual value guarantees, any exercise prices for a purchase option, any penalties for terminating the lease, and any other payments that might be required. That's the thing with these contracts, is a lot of times they have a lot of specific details in there that would need to be accounted for. So make sure that you're actually reading these leases and understand them from the beginning. Any variable payments that are based on a future performance or, using the asset should not be included, because you can't readily determine what that number is going to be. From the lessor side, remember, any leases of assets held as investments should follow GASB 72. And there's also an exception for regulated leases, such as those with airports or air carriers. For the lessor, the receivable is valued essentially the same as the lessee's liability, except that amounts to be received for the exercise price or penalties for termination are recognized when those options are exercised and not when they're reasonably certain. So one of the interesting things between GASB 87 and the FASB version of this is in GASB 87, the lessor will not de-recognize the underlying asset. If they have that on the books, they're going to continue to capitalize that on their books as they have in the past. In certain situations with FASB, there's actually a de-recognition that happens. So just an interesting thing that's different about the GASB version. So on to our next poll question.
So a lessee will initially report an intangible lease asset. They'll also report a liability. And the amount of that liability is equal to the contract, the fair value of the lease asset, all payments added together, or the present value of future lease payments. So one question that we can I'll try and have you answer, Becky, as we're waiting for all the answers. What if you pay off a lease in the first quarter of the first year reporting? Do you still report the lease if there's no lease balance at year end?
That's a great question. I think that because you're having to go back to the beginning of the period, you need to determine was that amount material? And if it is, then I think you'd at least have to get the activity in there. I will say, I think, obviously we have a lot of learning to do. As AJ said earlier, with GASB 84, a lot of decisions were made. And then after we got more guidance, we looked at it and went, oh gosh, that wasn't correct. So it's very possible that we're going to have some of that with GASB 87 as well. Because even though the guidance has been pretty good, I still think there are so many scenarios that haven't been included. So that's kind of my initial thought on that, but I could be wrong, or there might be something that comes out that says differently.
Yeah, I think we would need to think through, what are the potential impacts on opening a net position? And then if it's in a fund that reports a cash flow statement, if you're not
Exactly.
reporting the lease liability, you could have an impact potentially on a cash flow statement.
Yeah, I couldn't agree more, because I think if the activity is material, then that could be an issue. So 74% said present value of future lease payments, and that is the correct answer. Again, gave it a little easier one as we're making our way through the rest of our presentation. So after our initial reporting, we'll then have to do subsequent reporting in future years. And so that's where we're then going on the lease side. We're going to amortize that lease asset over the shorter of the useful life or the lease term, whichever shorter. And we're going to reduce our liability by the lease payments, less any amounts for interest. So that will continue to reduce those amounts. On the lessor side, for the assets, we're going to depreciate that leased asset unless it's got an indefinite life. And we're going to reduce the receivable by those lease payments that we receive, less that same amount to cover accrued interest. And then we're also going to recognize revenue over the lease term in a systematic and rational manner and reduce that deferred inflow. Also, in subsequent reporting, you need to consider if there were lease changes, but you should only remeasure if the changes to the lease are individually or in the aggregate expected to be significant. And so the things that you need to consider are any changes in lease terms, any relevant factors related to the residual guarantee, any relevant factors on the impact of any purchase options and what the likelihood is for that. Also, any changes in the estimated payments that were included in the initial measurement. You need to factor in if there's a change in interest rate from that initial discount rate. And is there a contingency that converts any variable payments to fixed? The leasee, however, should only update the discount rate used if there's a change in the lease term or the factors related to the likelihood of a purchase option have changed. So you're not going to necessarily remeasure for every little change. It's going to depend on what that change is. A lease liability is not required to be remeasured solely for a change in an index rate. So just remember that that doesn't have to happen. But if there are other factors involved that change as well, then you would have to remeasure. And lessees, both lessees and lessors should reassess the lease term only if one or more of the following occur. If either elects to exercise an option, even though it was previously determined that it was reasonably certain they wouldn't exercise that option. If either elects to exercise an option, even though it was previously determined that it was reasonably certain they would. So, any changes to that reasonably certain criteria would need to be reassessed. And then an event specified in the lease contract that requires an extension or a termination. So those are the situations where the standard says you should reassess. All right, on to another poll question.
Is the amortization of the leased asset required to match the amount of principal lease payments? Yes or no? So Becky, back to a short-term lease question. So if the lease contract is 12 months and then goes month to month with the option to cancel by either party, would you consider that still the 12 months or with those optional amounts to extend? Make it greater, even though
If the extension is month to month, then the maximum, they have an option to cancel, you said, both sides?
correct, yep.
Yeah, so that would mean the greatest would be the 12 months because the extension would be a month-to-month extension. And there's no defined term on what that extension is.
All right,
And then also the option to cancel also kind of takes that away as well.
right.
Because if they can cancel at any time, then you don't have a defined term.
All right, so we're going to end this poll.
All right. All right, so 59% of you said no. And in the standard, there is no requirement that the amortization for the leased asset match the amount that the principal lease payments are reduced in the liability. So, and often based on the way that you're going to put this together, it will wind up being different numbers, which I would like to see them the same because it certainly would make it a little easier to make sure that the accounting's accurate, but it does not have to be. All right. As far as disclosures, I'm hoping that the next time that we are able to present this presentation that we have some real life examples. The standard's still a little new to really show you examples, and the implementation guides did not give like full-blown good examples. So I'm hoping that something comes out on that, or the pioneers put some things together from our early implementations, and we'll be able to share that in the future. But the criteria for your disclosures are, of course, a general description, the total amount of the leased assets, and that needs to be by your major classes of underlying assets, along with the accumulated amortization. And that would look just like you expect it to look, except we'll have some extra line items in your capital assets disclosure that talk about these amortized categories. The amount of any outflows of resources recognized for the period for any variable payments or other payments like residual value guarantees, penalties, those kinds of things that have not previously been included in the measurement of the lease liability. Of course, we're going to have a principal and interest maturity schedule with the next 5 fiscal years and then 5-year increments thereafter. So that's very similar to what we were already doing with the normal lease disclosures from the past. You also need to disclose any commitments under the leases that have not yet begun, unless they're short-term. And then any components of net impairment loss recognized on the lease asset during the period. For lessor disclosures, some similar things. Of course, the description of the leasing arrangements, the total amount of inflows of resources, so that lease revenue and interest revenue, if you haven't displayed it elsewhere already, the amount of any inflows of resources recognized for variable payments, residual guarantees, and penalties, if they haven't previously included those in the measurement of the lease receivable. And then if there's any terms, conditions, or of options by the lessee to terminate the lease or abate payments, if the government has issued debt for which the principal and interest payments are secured by the lease payment. So you just have to disclose what's going on with that. Some other topics covered by 87 that we're not going to go into today. Obviously, we probably need a 4-hour CPE to cover everything in the standard, but just know that it's there and be prepared to go to those questions in the standard. But you got contract combinations, lease modifications and terminations. What do you do when you have those changes that we talked about that trigger a remeasurement? How to handle those lease incentives. We talked a little bit about that, and we'll have an example on that. Subleases. Remember, subleases are actually going to be treated as a separate transaction. So those should be included, separately, but definitely be included. And then if you have sale leasebacks or leaseback arrangements, those have special rules involved as well. So there is an implementation guide, number 2019-3. It has 80 questions and answers about the implementation and illustrations. And we're actually going to go through those illustrations today real quickly. So the first example is a city enters into a lease contract to obtain equipment. The lease begins on January 1st, 2021, the first day of the city's fiscal year, and is for 60 months. The city has an option to extend the lease for an additional 24 months. However, the city's unsure whether it will exercise that option. After the end of the 60 months, if it doesn't extend, or 84 months, if it does extend, then the lease can be continued on a month-to-month basis. A little more information here. The base monthly payment is $1,000 due on the first of each month, and it includes 200 machine hours. If the city uses more than 200 machine hours in a month, it is required to pay $5 per excess hour. In addition, the contract requires 80 monthly payments for repairs and maintenance. And then in any month-to-month period, each monthly payment can be adjusted upward with a CPI. The lease contract states an interest rate of 4%. So that's good. We don't have to worry about what our incremental borrowing rate is going to be here. And there is a separate contract with the lessor for delivery and installation of the equipment, which is due with the first lease payment. So we have some questions. The first is, what is the lease term? What's our initial measurement to get the lease asset and liability on the books? Then what are our initial governmental and government-wide journal entries? And then what are our subsequent year journal entries? So we're going to do a poll question with this.
So question one, what is the lease term, for example? 60 months, 84 months, or indefinite? Just want to make sure everyone's voting for their CPE credit. Almost there. Somebody about to end the poll.
All right, and the answer is 60 months. We had 61% of you select that. And I'm going to explain that here in the next slide. So the non-cancelable period is the 60 months because they're not reasonably certain that they're going to exercise that option. That is why our term would only be the 60 months. If that flipped and they did expect to extend, they had, history where they've extended these types of leases before, or they've already discussed some of that and that's the reasonable expectation, then it would be the 84 months. But in this case, it's only the 60. Those month-to-month extensions also wouldn't be included because these are not enforceable. Either party can cancel at any time. So 60 months is the right answer here. As far as the initial measurement of the asset and the liability, this is where we kind of consider all of the different components for this lease, starting with our base payment. So when we take $1,000 a month for over 60 months and discount it at 4%, we get $54,480. We're not going to include any excess use charges because those are variable payments that are based on the future usage. And those have to be excluded from, we can't calculate that now and determine what that could be now. So we would exclude that from our measurement. As far as repairs and maintenance, any service, non-lease type components are excluded unless it's not practicable. So, if it's already included in the number and there's really no way to break it out, then you would include it. But if it's based on some components and you're able to exclude that, then you should. So our initial value for our lease liability is $54,480. And then we're going to consider that delivery and installation, which are initial direct costs. Those have to be included in the value of our asset. So in this case, our asset and our liability won't match because of that $1,500 in delivery and installation. So I wanted you to see an example that, where it's not always going to match perfectly. And that's because you have other components to consider. So what does the initial entry look like? Well, on the governmental fund entry, we'd show a capital outlay for the amount of the leased asset of $55,980. And then leased other financing source lease proceeds of $54,480. And then we would have paid cash in that first payment for that delivery and installation of $1,500. For the government wide, we're going to eliminate that lease proceed entry and move that to lease liability. And then we're going to eliminate the capital outlay and record that as an intangible lease asset. And in this case, we did dash equipment so that we would have that to the right classification for our disclosure purposes. If this was an enterprise fund, then we would have recorded this directly as an intangible lease asset, and then the offsetting lease liability and the cash difference for that delivery and installation. In subsequent years, we're going to record the principal payment and the related interest. It was $1,000 payments per month, if you remember. So we've got $12,000 of cash going out during the year. And here's the breakdown based on this first year amortization schedule. So this is just an example where we have all the pieces of the amortization schedule for that first year so that you can get the total to record. And then subsequent government-wide entries are going to reduce our liability and amortize the asset. And the asset, that calculation is based on that full amount of the lease asset, including that delivery and installation, divided by 60 months, and then multiplying by 12 months to get that annual amount. As far as an enterprise fund, this is what the entries would look like. So the same numbers, but this would go to an enterprise fund situation. Second example is an office space example. A city enters into a lease with a discretely presented component unit, and they both have June 30 year ends. The city's current rental agreement's expired and the city is electing to relocate to a new, larger office space. As part of the agreement, the component unit has to install a entry security access at each entrance, and that's going to cost us $2,500. The agreement begins July 1st, 2021, and the term is for 1 year, with an option to extend for the next 4 years. With prior history, the city has elected to extend, so they currently intend to do the same. The agreement calls for monthly payments due on the first of each month of $1,962. There's no stated interest rate mentioned. However, the leasee's estimated incremental borrowing rate is 4%. So same questions as we asked before. but these are from the lessor perspective. So first is the lease term. It is 60 months because it's reasonably, it's certain that they'll extend. So this was the 1 year initial period plus the 4 years of reasonably certain extension. For our initial measurement of the asset and the liability, we're going to take those payments of 1962 times 60 months, and that's going to give us 117,720. And when we calculate the present value at 4%, it's 106,890. So we're going to record the receivable and the deferred inflow of resources to offset that. And then that $2,500 that we incurred to for the security access would be recorded as a expenditure and expense and related cash. In subsequent years, we'll receive cash from the lease and reduce the receivable, as well as record our interest income. And then we're going to reduce the deferred inflow in a reasonable manner. All right, so poll question.
So how should the lessor recognize the deferred inflow of resources in the subsequent periods? So straight line method over the lease term, in a systematic and rational manner over the lease term, amount of the reduction to the lease receivable for that period, or any of the above. As long as we're voting, Becky, another lease related question, not for this exact question, but so if both parties must agree to extend it to be considered if both parties must agree to extend for it to be considered a cancelable period, I think, wow, it's kind of written in a different way. If both parties must agree to cancel or both parties must agree to extend, would that be considered non-cancelable?
I would have to go back because the language is pretty specific on which parties. But I think you would look at, if it's both, then you would look at the reasonable certainty of both doing that in your evaluation.
Okay. Thank you. All right, so we're about 90% voted. I'm gonna end the poll.
All right, so I knew that this was one of the questions, kind of like AJ does, where the answer really could be any of these. The technical correct answer is B, in a systematic and rational manner over the lease term. That's exactly what the terminology says in the standard. But when you look at the application of this, any of these other answers would be correct, because all of these are systematic and rational ways in order to amortize it. So, any of the above would be correct, as well as B. All right, and then our third example is a building lease with a rebate. So I wanted you to see a non-vanilla example. So in this case, we've got a utility that enters into a lease for a building with a non-cancelable term of 10 years. Payments are $15,000 fixed at the beginning of each year. And at the end of the first year, there's a lease incentive of $5,000 that the utility is entitled to. The discount rate is 6%. So remember that the lease incentive is to be treated as a reduction of the lease payments. And because the incentive is provided at the end of year one, it's determined that the incentive is a reduction to the second year's payment and would be factored in the present value for that second year. So what are our questions? And it's the same questions we asked before. What's the lease term? What are the initial enterprise fund journal entries? What are the year one payment journal entries? And what are the year two payment entries that will include that lease incentive rebate? So our first question, what's our lease term? That's clear. It's a non-cancelable term of 10 years. As far as our initial entries, when we take and calculate our present value of our 10 years of $15,000 payments, we get $112,307. We're recording that. If we were doing full-blown governmental fund accounting, we'd record that as a capital outlay and another financing source, lease proceeds. Now, this is the lease amortization schedule so that you can see the placement of that incentive. And we would include the present value of that incentive in the calculations. And then it also shows you the amortization with the interest effect for those principal payments over the course of the 10 years. So our initial government-wide entry is going to move that financing source lease proceeds to a lease liability, and then move that capital outlay to an intangible lease asset. This one we're calling building for the category. If this was just an enterprise fund entry, then we'd have a straight entry to the lease asset and the lease liability. In subsequent years, we're going to reduce the lease liability. We had no interest in the first year because it was paid at the beginning of the year. So we didn't have any opportunity for that interest to accrue yet. So all of the $15,000 in cash would reduce the liability. And then we would take our $112,307 lease asset, divide by 10 years, and amortize that in a straight line method. Again, you could choose a different method for this. If you wanted to amortize it down equal to the lease liability, you could. It looks like in most examples that I've seen so far, most folks are doing a straight line method just to keep it consistent with how they're amortizing things on their other capital assets. For the subsequent year two payments, you're going to have to factor in that incentive, which reduced our cash payment. And so we're going to reduce our liability, record our interest expense, which will be a full year of interest expense at this stage, and then amortize that expense over a straight line method again. So here's our poll question related to lease incentives.
All right, so this is our last polling question. So which of the following is true about lease incentives? Reduce amount required to be paid for a lease. Known incentives are included in initial measurement. Should be reduction of lease payments, or D, all of the above. We're getting close to the end of the presentation, so just make sure you vote to get your credit. We'll have to speed through the last portion here. Let's give people a couple more seconds. In the aspect of time, Becky, why don't you just go ahead and answer while people are finished voting?
Okay, so as y'all finish up, we're running about 74% right now that say all of the above, and that is correct. All of those are true about lease incentives. So that's all we have for examples today. And so we just wanted to move on and announce a new implementation solution from CRI called CentraLease. This is a lease management software that is being developed with our CRI partners in coordination with CRI Advanced Analytics. And so it's going to be a cloud-based solution. And this is going to be a central repository for all your lease documentation. The program will be able to handle both GASB and FASB requirements. So in some situations, if you have an entity that kind of deals in both worlds, you'll be able to handle those in the same solution. The reports will provide detailed information on the amounts needed to record the leases and to handle all of your disclosures. And the sample disclosures will meet all of the related professional standards. So we are in the process of developing this, and we expect be looking for a webinar in July to actually fully launch and make this available to you. What we're looking to, our most important focus on this was to try to bring a solution to those small and mid-sized governments and CPA firms that may only have a small number of leases, but still need a solution that would help them, that's affordable and easy to use. So we're developing this in mindset of trying to make it as easy as possible to be able to enter yourself. And then also if you need assistance, that our CRI personnel would be able to consult with you and help you through that process as well.
So I think the questions that were posted through Zoom during the registration have been answered by AJ and Becky today. So we won't spend any more time with office hours today. Typically, we have some time at the end where we go through other questions, but I think all those questions have been answered at this point. So just want to make everyone aware, so today was our second of 4 CPE webinars this year. Our third one is coming up in June, and we're going to be talking about controls. We're going to be talking about entity-wide controls, cybersecurity types of issues, and then some automated controls that governments should be thinking about. And you'll have some information come out on that relatively shortly. And then the last couple of items, want to thank AJ and Becky for their wonderful presentations today. And then CRI does have a podcast that we put out, information. You can find it on any of your podcast areas. We do have actual specific government related podcasts that come out periodically, so you can see everything on there. And I want to connect with us on social media. We're everywhere most everyone is, all those same places. We'd love to connect with you in social media. Then just thank everyone for their participation today, and we'll get those CPE certificates out as soon as possible. So thanks everyone. Look forward to everyone coming back in June. Thank you.